So I've been asked today to talk about our business valuation service. Um, there could be many reasons why a business is valuing, but it's important for many, many reasons. For example, it could be a share scheme that's been implemented to incentivize the management team, for example, an enterprise management incentive. It could be for a different type of share scheme, unapproved share scheme. Similar, it could be that we want to do some estate planning, and therefore the value of the shares is important now in order to determine, for example, the value of a new class of shares, a capital growth share, something like that. It may be that it's coming up to the vendor wanting to sell their shareholdings, or there's been a shareholder dispute and one shareholder is going to sell to the other, and therefore they want to get a fair value of those shares. So that occurrence where shares are being sold by one party to another, or there's a vendor initiated management buyout looking to acquire shares, then the first, or one of the first starting points is to determine the value of the company. Often a vendor may have a different idea of what the value of the business is compared to the purchaser. So it's important to have that independent valuation. And therefore, it's also important to look at the methodology adopted. Many people talk about EBITDA and applying a multiplier. A multiplier is not always the appropriate way necessarily to value a business. EBITDA is an important method, but it's one method of approximately 9 general methods that are known for valuations. And even with those 9 methods, they may not all be appropriate depending on what type of business is or what the business is intending to do in the future. So there's a number of factors that need to be considered. It's not a case of simple formula applied to each business time and time again to work out the value. It could adapt and change depending on the type of business. So we need to consider the type of business and what type of valuation or what methods are used. So maybe more than one method is, and it may be that we take a proportion of different types of methods of valuation in order to determine the overall valuation, or we use the preferred method of valuation and we use other methods of valuation in order to test whether that valuation is accurate or not. And that may give us a basis for movement on valuing the shares of the business, for example, or bringing that value down or increasing it depending on factors that relate to it. Now, when you are valuing the business, there's a number of factors that could change the valuation of space. For example, if you had a property-backed business, you are unlikely to value that based on EBITDA. You're more likely to value it on the value of the underlying assets, which could mean that you have to instruct people to value it. Now, if you've got a mix of a trading business that also owns property, then you've got to do a mix valuation to consider what the assets are held by the business. It might be commercial property, for example, or they may have actually be like a lease business where you've got an asset value that's been acquired and then is leased out, so you've got income stream. So you may actually do a basis of valuing based on assets as opposed to necessarily all on the income stream. Now, valuation basis can also be affected by how the business is operated or how well it's managed. For example, contracts are quite important in determining the recurring value of the business. So if, for example, a business is getting X amount of income every year, but there is no legal basis for that income to be recurring in future years, there's a certain risk to the business. It may be that significant management team aren't tied in contractually, they're on short notice periods, and that can also affect the value. So we also look at contracts as well as the accounting information and the information in the wider universe, if you like, of the wider world, in order to determine the value. With all businesses, anomalies can pop up. And that's, it could be that the business has had, we had one recently, it was a valuation where the vendor wanted it valued, but there have been one-off. The trading transaction was very unlikely to happen again, but the value including that year would obviously put a higher value on the overall business because it was responsible for about 75% of the income in that year. But then if you looked at the few years and said, well, there's no chance of that recurring again, we have to discount it subject to the cash that's now held in the company by virtue of that transaction in order to determine the value. The vendor would have preferred an EBITDA multiplier applying to it, but we didn't think that was fair in that situation. So you can have one-off transactions on unusual trading transactions that can affect the value, and you need to strip them out. Same with unusual expenditure. For example, you may have terminated a very well-paid employee that's cost a lot of money to move them on, or you may have had a legal battle or legal costs, and that's an unusual expenditure. You may make adjustments for them. Other valuation methods that could be adopted depend on the type of business that I mentioned earlier. For example, if you had a royalty stream business or an intellectual property business, the valuation may not necessarily be on asset basis, it may be on the income generated from it and the longevity of that income, and whether, for example, we have a portfolio of music releases, and if we're valuing that business, do we look at the historic value in the income that it generates, and do we diminish that over a period of time as the music becomes less popular? Alternatively, if, for example, it's an album book of, for example, Christmas songs, that stream of income may be steady for the next forthcoming future years. So the valuation basis you adopt can have to move with the type of business you're looking at. Now, our valuation services, or the skills in developing our valuation service, comes very much from a different background to most companies doing valuations. We have had the fortune of dealing with valuations office and HMRC disputes as a practice, and our valuation service is derived from where valuations have been challenged by HMRC, whether that's on businesses or assets, and then we've devised our processes around those valuations. We've done quite a lot of specialist type valuations because they're generally the ones that get challenged, and therefore we've got quite a niche in those areas. And what we do is we've got a team here of professionals that obviously have experience of dealing with valuations, and we've also got a team that deal with risk management and value businesses, or identify risk on business sales, for example. So when I was at my previous firms, and even this firm, we have gone into businesses to identify what the risks are, whether the valuation of the business should be discounted. So coming from that basis, it's a very strong point to look at determining real commercial value for a business. Now, with any valuation, there's certain primary information that will be required. This can't be avoided. For example, we will look at the articles, which are generally on Companies House, but we'll look at the Articles of Association, and how the company has had its filing history at Companies House. We look at accounts for a period of at least 3 years, maybe longer. We would like management accounts for the current year. We look at statutory documents, books and records to see how well the company's been run and what risks are exposed to. We'll look at employment contracts, shareholders agreements, customer contracts. Depending on how accurate the valuation needs to be, we may actually undertake due diligence visits. That's testing whether there's risk associated in the business on a corporation tax level, PAYE level, a VAT level, a contractual level from a legal point of view of recurring income. And that will help us determine whether it is an exceptionally well-run business that deserves a premium value, or a business that has a few more problems associated with it in securing income or being stable going forward, and therefore would warrant a lower value. We will look at the method that will be adopted. Normally, we will choose 3 standard methods, which we things like EBITDA and multiplier, dividends or possible dividends, and asset-backed valuation. We may choose other valuations depending on the type of business, other valuation methods that is, and we may choose proportions of them. For example, if there's assets held in the company, we may say, well, actually, a proportion of the valuation has to be based on asset-based valuation, a proportion has to be based on EBITDA. If the dividends are non-existent, we wouldn't do necessarily based on dividends, but we would look at what the possible dividends would be to create a situation of, well, this is the income stream that could be earned from that business, and therefore it would have certain values. Those type of method of valuations are used to compare with each other to see whether the valuation process is coming up. And what you might often find is an EBITDA will give one valuation, but the dividends could give a far greater valuation, and therefore you have to look at the judgment value. So, well, in one shareholder's hands, it may be valuable for that, and another shareholder's hands, it may be valuable for another reason. And you have to sort of look at the business in detail to be able to find what method is appropriate. I've already mentioned intellectual property and royalty-based businesses, and looking at income stream and discounted income streams. That's something that we have specialised in, and we've had much debate with the Valuations Office on. Alongside that, the work isn't just about taking a methodology of calculation. It's about doing some research in the market and seeing what competitors are being sold for, what competitors are doing, and whether you're in line with competitors, whether you're a better business or a worse business. Also going to the market and looking at the multipliers of public listed companies, but also reported sales of small businesses, which, if you know where to look, you can find them. And that may be both UK and overseas, depending on what the business is. So you pull up this research information and therefore have a basis of which to either apply a discount or apply a higher valuation than before. The discount basis basically looks at the risk of losing income quickly or losing income to the market, to the competition, by virtue of new technology, the speed that it can get to the market, the marketing discount that might have to be applied if it's not an easily, readily sellable business. Looking at the economics, there's no bringing in one particular area that's been superseded by another, or one particular area that has benefited from some economic growth over the past 5 years, but that economic growth is now declining. So there's lots of factors to look at when valuing a business. It's not just a case of taking the numbers from account and putting together a valuation. There are also lots of reasons why a valuation needs to be taken. And if it's for tax reasons, which often many of our valuations are, then that valuations need to consider what the risks are, HMRC challenge, and how they can be best managed.